For decades, the COMEX silver ledger has been treated as a quiet, almost background system, monitored by institutional traders but rarely questioned outside of specialized circles. Registered silver, held in warehouses and designated as immediately deliverable, has long been the barometer for physical liquidity in the market. Yet, in recent weeks, that once stable measure has experienced a shift that few outside of trading floors have fully appreciated. Data indicates that more than 4 million ounces of registered silver have moved out of inventory in a window of days, a volume that under normal conditions would take months to transact. The departure of this stockpile is not the result of standard hedging or settlement activity. Market participants familiar with warehouse flows describe a combination of withdrawals that suggest concentrated, coordinated pressure. The speed of the drain is raising questions about whether registered silver can continue to serve as a reliable anchor for the market. Analysts are beginning to wonder if what's visible on the COMEX ledger still reflects true availability, or if a deeper mismatch is emerging between paper claims and physical reality. Even more striking is the behavior of warehouse inventories across multiple delivery points. Certain locations that historically maintained consistent stock levels are now reporting anomalies. Shelves that once held millions of ounces are showing abrupt declines, while transfers between depositories are accelerating without clear demand justification. These movements are quietly changing the risk calculus for participants who rely on registered silver to hedge positions or meet delivery obligations. Reports indicate that some of the largest withdrawals are coming from accounts traditionally used by major bullion banks. These institutions are not only moving metal off the books, but are apparently reducing the amount of silver classified as immediately deliverable. The implications ripple beyond the COMEX itself, touching refiners, ETFs, and industrial users who count on registered silver as a baseline for operational security. Yet the reasons behind the withdrawals remain opaque, leaving observers to parse incomplete data and subtle market signals. The flow of registered silver is intersecting with broader market pressures in ways that amplify risk. In particular, open interest on COMEX contracts has remained elevated even as physical inventories fall, a combination that implies more paper claims than metal on hand. Traders with access to detailed ledger data note that these positions are increasingly concentrated in a handful of accounts, suggesting that a limited number of participants could influence the apparent supply situation. This concentration introduces a fragility that is rarely discussed publicly, but is evident in the trading patterns and settlement timing. At the same time, silver leasing activity has shown unusual volatility. Institutions that normally lend metal to generate yield are reportedly calling back loans or delaying further leases. The net effect is a tightening of the pool of metal considered free and available, which can cascade into pricing stress when obligations must be met. Historical patterns indicate that when leased silver is rapidly withdrawn, markets often experience abrupt shifts, but the current scenario differs because the withdrawals coincide with broader liquidity constraints elsewhere. Industrial and commercial users of silver are quietly adjusting as well. Refiners and manufacturers are reportedly securing longer-term agreements and alternative sources, anticipating that immediate delivery from traditional channels may not be dependable. The behavior suggests that the perceived stability of registered inventories no longer provides a reliable hedge for operational planning. In some cases, these adjustments are already feeding back into market dynamics, influencing futures pricing and spread behavior in subtle but measurable ways. What remains uncertain is whether these withdrawals are tactical, responding to anticipated market moves, or symptomatic of structural stress in the registered silver system. The speed and scale of outflows hint at a scenario where confidence in immediate delivery may erode further, potentially exposing gaps between paper and physical positions. Observers are left trying to read signals from limited disclosures, ledger snapshots, and whisper-level reports, a challenge that few outside the inner circles of trading desks are equipped to navigate. Warehouse dynamics are adding another layer of complexity. Analysts monitoring COMEX delivery points note that internal transfers between facilities have accelerated sharply, often within hours of large withdrawals. While some of these movements can be chalked up to logistical efficiency, the sheer frequency and scale suggest a strategic repositioning of metal rather than routine handling. The pattern implies that participants may be attempting to concentrate physical silver in locations they perceive as most secure or perhaps most advantageous for future settlement demands. Meanwhile, reporting discrepancies are becoming more apparent. Some depositories show declines in registered silver that aren't immediately mirrored in published COMEX inventory updates. The lag between actual movement and reported availability creates a fog that obscures the true supply picture. Traders relying on official data may be underestimating the pressure on deliverable metal, a risk that becomes significant if futures contracts come due or margin calls intensify. Insider accounts indicate that certain market participants are quietly taking delivery of metal to hedge against uncertainty, bypassing the typical short-term speculation that dominates COMEX activity. This subtle shift in behavior is not yet visible in aggregate volume metrics, but it changes the underlying structure of supply. If this trend accelerates, it could fundamentally alter how registered silver is perceived, not as a static reserve, but as a dynamic, increasingly contested asset. Even seasoned observers note that these developments challenge assumptions about liquidity buffers. Historically, registered silver has functioned as a stabilizing component, providing confidence that paper positions could be settled physically. Now the rapid outflows, coupled with uneven reporting, are exposing vulnerabilities that could have downstream effects on pricing, risk management, and market psychology. Settlement practices are under renewed scrutiny as these movements unfold. Reports from participants indicate that delivery notices are being issued and fulfilled at unusual rates, sometimes in batches that far exceed normal patterns. The speed of these transactions is not merely operational. It implies that counterparties are actively prioritizing physical acquisition over holding paper positions. Market behavior suggests a latent tension. Those with access to metal may be consolidating control, while those without are increasingly reliant on delayed or uncertain delivery. Simultaneously, margin structures in the futures market are beginning to reflect this hidden stress. Some clearing members are adjusting requirements for silver contracts, responding to internal assessments of liquidity risk. While these adjustments are subtle and technical, they can influence trading strategies, hedge positions, and even the willingness of participants to engage in standard contract roles. The interconnectedness of registered silver, margining, and paper positions means that localized pressures in depositories can propagate quickly through the broader market. The interplay between ETFs and physical withdrawals is also noteworthy. While ETFs hold metal on behalf of investors, their redemption behavior can magnify supply pressures in underlying registered inventories. Analysts tracking flows report that redemptions have accelerated recently, creating additional strain on warehouses and revealing how interdependent these layers of the market have become. The pressure is not overtly visible in pricing yet, but subtle signals suggest that structural stress may be quietly building. What remains unresolved is how participants will respond if these pressures intensify. The combination of concentrated withdrawals, rapid internal transfers, and evolving margin and redemption dynamics hints at a market that is increasingly sensitive to shifts in physical availability. Every movement now carries the potential to ripple across multiple segments, leaving the ledger an incomplete reflection of underlying risk. Shadow markets and off-ledger flows are now emerging as critical variables. While COMEX inventories track registered silver, there is evidence that large quantities of metal are circulating outside formal reporting channels. Refiners, vault operators, and private dealers appear to be adjusting positions in ways that are opaque to standard market watchers. Available data suggests that these off-ledger movements are not random but coordinated, likely reflecting attempts to secure immediate availability in anticipation of settlement or delivery pressures. These unreported flows have implications beyond liquidity. They influence pricing signals. Future spreads, backwardation, and bid-ask differentials may now reflect scarcity or localized concentration rather than broader demand fundamentals. Traders who rely solely on published inventories could misinterpret the market's underlying condition, assuming stability where strategic repositioning is actually underway. The risk is that sudden disclosures or reconciliations could trigger abrupt revaluation. Reports indicate that some participants are using warehouse receipts as collateral in creative ways, further decoupling paper positions from physical holdings. While the mechanics are complex, the effect is clear. Registered silver is no longer a straightforward proxy for deliverable metal. Each transaction, whether on or off ledger, alters the landscape subtly but meaningfully, introducing friction and uncertainty into what was historically a reliable system. Institutional risk managers are now reportedly re-evaluating assumptions about buffer inventories. The combination of rapid withdrawals, internal transfers, off-ledger flows, and derivative overlays is forcing a reconsideration of how much metal is genuinely accessible at any moment. The question moving forward is whether this recalibration will stabilize quietly, or whether it sets the stage for further, more visible stress in registered silver markets. Regulatory scrutiny, while historically limited, is beginning to intersect with these developments in subtle ways. Public filings and routine audits offer only delayed snapshots, leaving much of the action invisible until after movements have already occurred. Yet market insiders report informal inquiries and heightened internal compliance reviews at several large institutions, particularly those managing substantial registered silver balances. These reviews are not yet public, but they signal that custodians are aware of the potential implications for settlement integrity and counterparty exposure. Meanwhile, the interplay between industrial demand and financial positioning adds another layer of tension. Available data suggests that manufacturers and refiners are seeking alternative sourcing arrangements to mitigate delivery risk, while paper market participants are increasingly reliant on existing registered inventories to meet contractual obligations. The collision of these two dynamics creates a subtle but growing misalignment between what the market thinks is available and what can actually be delivered. International flows are amplifying the pressure. Reports indicate that some registered silver has been transferred across borders, often into custodial frameworks with differing reporting standards. While the total volume may appear modest relative to global supply, the directional movement matters. Metal leaving primary COMEX warehouses reduces the pool available for domestic settlement, altering the risk calculus for both domestic and international participants. All of this converges on a central question: how resilient is the registered silver system if withdrawals continue at the current pace? Each operational adjustment, transfer, or hedging decision interacts with others in ways that are largely hidden, leaving observers to infer stress from partial data, behavioral anomalies, and ledger inconsistencies. The answer remains uncertain, and the potential consequences are quietly mounting. Market sentiment among institutional participants is quietly shifting, even if broader indicators remain muted. Conversations within trading desks and risk committees suggest a growing wariness about relying solely on registered silver as a liquidity buffer. Available reports imply that some firms are preemptively hedging against the possibility that future deliveries may not align with paper positions, a move that could influence trading patterns and spreads long before any public acknowledgement occurs. Concentration risk is becoming more pronounced. Data points to a smaller number of accounts controlling increasingly large shares of registered silver. Historically, such concentration has been manageable, but in a context of accelerated withdrawals and off-ledger flows, it introduces a vulnerability. A single participant's actions could materially affect market equilibrium. The question now is not just availability, but how quickly the system can respond if pressure intensifies. Settlement timing and futures contract behavior are reflecting this latent fragility. Analysts tracking delivery notices note that certain contracts are rolling unusually early or with atypical premiums, suggesting that participants are anticipating potential scarcity in physical allocation. While these anomalies are subtle, they are consistent with a market recalibrating around constrained deliverable supply. Each adjustment hints at an underlying tension that could surface more visibly if ledger flows continue to diverge from expectations. Amid these developments, the broader implications for risk management and pricing conventions are becoming harder to ignore. Registered silver has long been treated as a foundation for confidence, but the ongoing dynamics, rapid withdrawals, concentrated holdings, off-ledger flows, and settlement anomalies are quietly testing that assumption. The market's next moves will depend on a complex mix of transparency, behavior, and the rate at which remaining inventory can absorb ongoing pressure. Liquidity signals are now intersecting with market structure in ways that could reshape short-term dynamics. Analysts note that spreads between spot, futures, and ETF-tracked silver are beginning to reflect subtle tension, even without dramatic price moves. The interplay between limited registered inventory and concentrated positions creates conditions where conventional hedging strategies may be less effective, introducing friction that could propagate rapidly if withdrawals continue. Simultaneously, behavioral patterns among custodians and clearing members suggest a heightened sensitivity to delivery obligations. Reports indicate that some institutions are adjusting internal limits, delaying transfers, or reprioritizing clients to manage perceived risk. These adjustments are operationally discrete but strategically significant, as they influence which participants can access immediate metal and which must rely on deferred delivery. Market observers are also watching for secondary effects in related metals and industrial inputs. Even modest volatility in registered silver availability has the potential to ripple through pricing of silver derivatives, alternative stores of value, and contracts dependent on physical delivery. Each movement, transfer, or hedge recalibration subtly alters the landscape, revealing how tightly interwoven physical supply, paper claims, and operational protocols have become. The critical question now is whether this environment represents a temporary recalibration or an early stage of more persistent stress. The combination of rapid withdrawals, concentrated holdings, off-ledger flows, and operational adjustments has left the market in a state where conventional indicators provide an incomplete picture. Observers are left to interpret signals from partial data, ledger snapshots, and institutional behavior, with the understanding that the registered silver system may no longer offer the stability it once did. What is clear from the patterns emerging across COMEX and affiliated warehouses is that registered silver can no longer be assumed as a static, easily accessible reserve. The rapid withdrawals, concentrated holdings, off-ledger movements, and operational adjustments together signal a structural fragility that was largely invisible until recently. For market participants, the implications are manifold. Hedging strategies that rely on immediate delivery may need re-evaluation, while those managing large positions are increasingly factoring in the possibility of constrained liquidity. The interaction between paper claims and physical availability has become more complex, with each adjustment potentially amplifying stress in unexpected ways. Ultimately, the registered silver system is now operating in a space where perception and reality may diverge. Observers, traders, and institutions alike must navigate partial transparency, evolving behaviors, and the consequences of concentrated withdrawals. While it is not a crisis in the traditional sense, the events unfolding point to a recalibration of assumptions that underlie one of the most closely watched corners of the metals market. The question remains, how will the market absorb this new reality, and what unseen pressures may emerge as participants respond to it?